Huge Fed news is continuing to reshape investor psychology, and the ripple effects are spreading far beyond Wall Street. This is no longer just a debate about interest rates or a disagreement between political leadership and central bankers. It has evolved into a broader test of confidence in the financial system itself. Markets are reacting not only to policy signals, but also to the underlying power struggle that is unfolding in plain sight. For gold and silver holders, this moment represents far more than short-term price volatility. It represents a crossroads. Donald Trump's renewed confrontation with the Federal Reserve has injected a new level of uncertainty into global markets. From the moment he returned to power, it was clear that his relationship with the central bank would once again be strained. Trump has consistently argued that the Federal Reserve keeps interest rates too high and slows economic momentum. In his view, lower rates mean faster growth, higher asset prices, stronger confidence, and a more competitive United States. This belief has guided his rhetoric and now, increasingly, his actions. At the center of this conflict is Jerome Powell, the current chair of the Federal Reserve. Powell's position is unusual in that he was originally appointed by Trump himself during his first term. At that time, Powell was seen as a safe, steady choice. But the relationship between the two deteriorated quickly when Powell refused to aggressively cut rates in response to political pressure. Powell's priority has remained controlling inflation and preserving long-term economic stability, even when that stance proved unpopular with the White House. This difference in priorities lies at the heart of the current turmoil. Trump believes the Fed should act as a growth engine, actively supporting expansion and market optimism. Powell and many within the Fed believe that such an approach risks overheating the economy, weakening the dollar, and allowing inflation to spiral out of control. These opposing views have now collided in a way that markets cannot ignore. Gold and silver became early indicators of this growing tension. Over recent months, both metals surged to historic levels. Silver experienced one of the strongest monthly rallies ever recorded, while gold climbed to heights not seen in decades. These moves were driven by a combination of inflation fears, geopolitical uncertainty, high government debt, and growing concerns about the long-term credibility of monetary institutions. Investors sought safety, and precious metals provided it. Then came the reversal. Prices fell sharply. Gold and silver exchange-traded funds recorded heavy outflows as investors rushed to secure profits. The immediate trigger was Donald Trump's announcement regarding the future leadership of the Federal Reserve. By publicly naming Kevin Warsh as his preferred nominee months before Jerome Powell's term ends, Trump sent a clear and deliberate signal. This was not a quiet administrative decision. It was a public challenge. Kevin Warsh is a former member of the Federal Reserve Board and is widely viewed as more open to interest rate cuts under the right circumstances. His background and past statements suggest a willingness to support more accommodative monetary policy if economic growth appears threatened. To Trump, this makes Warsh an ideal candidate. To markets, it introduces a new level of unpredictability. The reaction was swift. U.S. equity markets dipped, with major indices turning negative. Asian markets followed suit, closing lower as concerns spread about potential instability in U.S. monetary policy. Investors across asset classes began reassessing risk exposure. Gold and silver, which had surged rapidly, became targets for short-term profit-taking. But beneath the surface, the story is more complex. Precious metals are not just speculative assets. They are deeply tied to perceptions of trust, stability, and currency value. Short-term price declines often reflect tactical decisions rather than changes in long-term conviction. The forces that pushed gold and silver higher have not disappeared. Interest rates remain a central factor. Trump has openly stated his desire to see rates fall dramatically, even as low as 1%. Such a move would represent a major departure from current policy. Lower rates generally reduce the opportunity cost of holding gold and silver, making them more attractive over time. However, markets are struggling to price in how quickly and how decisively such changes could occur. The uncertainty is compounded by concerns about the independence of the Federal Reserve. For decades, the Fed's credibility has been anchored in its ability to operate without political interference. This independence has been critical to maintaining global confidence in the U.S. dollar and the broader financial system. Trump's public pressure campaign threatens to blur that line. Foreign investors, central banks, and sovereign funds hold massive amounts of U.S. assets. Their confidence rests on the belief that U.S. monetary policy is driven by economic fundamentals rather than political agendas. If that belief weakens, capital flows could shift. The dollar could face downward pressure, and in such scenarios, gold and silver often regain prominence as neutral stores of value. The investigation into renovations at the Federal Reserve headquarters added another layer of tension. While officially unrelated to policy decisions, the timing raised questions. Critics argue that it represents an indirect attempt to pressure Jerome Powell. Supporters dismiss this interpretation. Regardless of intent, perception matters in financial markets, and the perception of pressure has contributed to investor unease. When the Fed recently decided to keep interest rates unchanged, it reinforced Powell's commitment to caution. Almost immediately, Trump intensified his response. Meetings were held at the White House. Hints were dropped in public statements. And then the nomination of Kevin Warsh was made official. The sequence left little doubt that Trump intends to reshape the Fed as soon as legally possible. For gold and silver holders, this environment presents both challenges and opportunities. Volatility can be unsettling, especially after rapid gains, but volatility is also a hallmark of periods when underlying systems are being questioned. Precious metals have historically performed well during times of institutional stress and monetary uncertainty. Inflation remains a persistent concern. Even if short-term data fluctuates, the structural pressures of high government debt, expansive fiscal policy, and demographic trends remain firmly in place. Lower interest rates may ease borrowing costs, but they also risk eroding currency purchasing power over time. Gold and silver have long been used as hedges against such outcomes. Global coordination is another factor to consider. Central banks around the world closely watch the Federal Reserve. Any major shift in U.S. policy could trigger responses elsewhere. Competitive devaluations, divergent monetary paths, and trade tensions could all emerge. Such dynamics often increase demand for assets that sit outside traditional financial systems. Supporters of Trump argue that the Fed has been overly cautious and that aggressive action is needed to sustain growth. Critics warn that politicizing monetary policy could undermine decades of institutional credibility. Regardless of perspective, the outcome is likely to involve continued uncertainty. This uncertainty is not easily resolved. Jerome Powell remains in office until his term ends, and legally, Trump cannot remove him before that date. Yet the early nomination of a successor creates a shadow leadership dynamic that is unprecedented in modern history. Even though Powell remains the official chair, markets, investors, and financial institutions are already anticipating a potential shift in policy direction. This duality, where the current Fed chair holds power but the future chair's intentions are already influencing expectations, introduces a level of complexity rarely seen in monetary policy. Traders must now consider not only what the Fed is doing today, but also what it might do months from now, factoring in the potential priorities of the incoming leadership. This creates a continuous feedback loop of speculation, rumors, and sentiment-driven trading that can exacerbate price swings in equities, bonds, and commodities. The mere announcement of a nominee months before a term ends signals that political influence and market psychology are intertwined, and that investors cannot rely solely on historical Fed behavior to predict outcomes. Gold and silver prices reflect this tension vividly. On one hand, short-term traders respond quickly to headlines, statements, and news cycles, often selling on fear or uncertainty and buying on optimism. On the other hand, long-term holders tend to focus on fundamentals, inflation, currency stability, global demand for safe haven assets, and historical precedent. The recent pullback in gold and silver prices does not negate the underlying reasons many investors were drawn to these assets in the first place. If anything, it underscores how sensitive markets have become to political developments and policy signals. Even small comments from the White House, subtle indications of policy shifts or rumors about Fed moves can trigger outsized market reactions. In this environment, price movements are often driven as much by perception and speculation as by actual changes in economic fundamentals. Trust in institutions is being tested like never before. The delicate balance between political authority and economic expertise is under strain, and the very credibility of long-standing financial institutions is being questioned. Markets are adjusting to a reality where assumptions that once seemed inviolable, such as the independence of the Federal Reserve, may no longer hold. Investors, analysts, and international observers are forced to reconsider long-standing beliefs about how the U.S. economy is managed. In such periods of uncertainty, assets with a long history of preserving value, like gold and silver, often regain attention, acting as a hedge against not just inflation, but also against institutional instability and potential policy missteps. The battle over the Federal Reserve is about more than interest rates, although those rates remain central to the debate. At its core, this struggle is about who ultimately controls the levers of economic power. Gold and silver have endured countless such moments throughout history. They have served as refuges during wars, financial crises, banking collapses, periods of high inflation, and times of deep political uncertainty. Their role does not depend on political leadership, economic ideology, or central bank mandates. Unlike paper currencies or government bonds, gold and silver maintain intrinsic value across decades and centuries. That historical stability is precisely what makes them relevant in times like these. Even when markets are roiled by speculation, volatility, or political maneuvering, gold and silver provide a tangible anchor, a measure of security that investors often turn to when trust in institutions wavers. As this situation continues to evolve, markets will remain sensitive to every development, no matter how small. Public statements by the White House, speeches by Powell or other Fed officials, news about economic indicators, and even procedural announcements regarding Fed appointments will all be scrutinized with extraordinary intensity. Volatility is likely to persist, and sudden price swings may occur as new information is digested by traders around the world. For investors, this is a period where patience, perspective, and a deep understanding of both monetary policy and global economics will be essential. Short-term price movements may seem alarming, but they must be evaluated in the context of the broader, long-term forces driving the markets. Gold and silver holders who maintain a strategic perspective are better positioned to navigate the turbulence and benefit from their enduring role as stores of value. Moreover, the uncertainty surrounding Fed leadership impacts not only domestic markets but also international confidence in U.S. economic stewardship. Countries holding large reserves of U.S. dollars or dollar-denominated assets monitor the Fed closely. Any perception that political considerations are influencing decisions could lead to shifts in global investment strategies, currency holdings, and trade balances. In such a scenario, the intrinsic security of gold and silver as non-political, universally recognized assets becomes even more significant. These metals act as a hedge not only against inflation, but also against systemic risk and the erosion of trust in global financial systems. Investors must also consider the psychological dimension. The knowledge that a potential new Fed chair already nominated may enact significantly different policies introduces uncertainty into planning, risk management, and portfolio strategy. Financial actors, from hedge funds to pension funds to retail investors, must weigh both current policy and potential future shifts in their decision-making. This creates an environment where markets are hyper-responsive to signals, even if those signals are anticipatory rather than actualized. Gold and silver, being assets historically associated with stability and value preservation, naturally attract attention during these periods of heightened sensitivity. Ultimately, the ongoing tension between the current Fed chair and the nominated successor illustrates a broader truth. Economic outcomes are influenced not just by data and policy mechanics, but also by confidence, perception, and credibility. Investors holding gold and silver are not just betting on commodity prices. They are also positioning themselves in anticipation of institutional and policy uncertainty. In moments like this, the historical resilience of precious metals becomes both a practical safeguard and a psychological anchor. This is not merely a story about price charts. It is a story about confidence, credibility, and control. Donald Trump has made his move. Jerome Powell has held his ground. And the Federal Reserve stands at the center of a global debate. For gold and silver holders, the coming months may prove decisive. The choices made now and the reactions to them could shape the trajectory of precious metals for years to come. The system is being tested, and history suggests that when such tests occur, tangible assets often emerge stronger. The world is watching, the markets are listening, and the outcome of this confrontation will not stay confined to Washington. It will ripple across currencies, economies, and investment strategies worldwide. This is the moment investors have been preparing for, whether they realized it or not, and it is far from over.